Hello traders, welcome to Cohort Wealth's second video. My name is James and today I'm going to be covering supply and demand with you and how we use it in our technical analysis and our trading. So first off, many people actually can get confused with supply and demand when comparing it with support and resistance. As when drawn on a chart, they can actually appear very similar. But if you watched our first video, and that was with Ollie, he covered support and resistance. And one of the major messages you should take away from that video is the multiple touches of a certain price area. Now, when we look at supply and demand, we often consider this to be just one touch of a specific price, or a very rapid movement into and out of a certain zone around a specific price. So, if we have just a real quick look at the chart for now, price is falling and it spikes into this area, specific price, and it shoots straight back out again. So, the way we define on a chart our supply or demand zone is pretty much we want to be looking for a specific area of price where price has shot into and rapidly moved out of a certain area. So, if we take a demand zone, for example, now, demand zone is where price has fallen fairly rapidly into a certain price. It could be a sentimental price, like a round number, 0.5 digit, and again, it's moved into that zone. It's fallen down into it, and it's fairly rapidly shot straight back out of that zone. So, on our charts, the actual demand zone itself is defined as a price where the price action has rapidly fallen into and back out of this area of price. And that's caused by a demand in the currency pair now, or the commodity or the asset you're trading. So this demand is caused by a sudden increase in the number of traders taking that asset long. In comparison, a supply zone is the price moving into a certain zone and rapidly back out of a certain zone, which is caused by a rapid increase in short sellers suddenly jumping in at a certain price that they think is particularly oversold or overbought. So when we actually look at it on the charts, you'll often see a rise in volume. Now this does give us a bit of an indication, or it gives us a better indication as to if this is truly a supply and demand zone or not. So the example we're going to be using today can be seen here. I think this was a couple of days ago. It's on just an hourly chart. But as we can see, there's a nice spike in volume as we fall into this area here. And we actually see the volume peak in these two candles here. If we take the price action just to the left of this area, because we don't actually, at that time, we're not seeing this price action here. We just always see this. So for us, we can now define this as our potential supply or demand zone. So this is the demand zone because price has fallen into this zone. We've seen a spike in volume and price has rapidly retreated back out of that zone. So with these zones, we can basically predict the future price action in a similar manner to support and resistance levels, because we can often see that the price will eventually retouch this zone and we can look to trade off it. They also allow for very accurate entries and exits, and to generally just predict or help us predict the potential future direction of the asset that we're trading. So firstly, I'd just like to go over how we shall draw this demand zone on our chart. So the method that we use is fairly similar to our support and resistance zones. However, what we like to do is first off take the lower candle of our potential demand zone. We want to take the lower wick and we put a nice horizontal line right at the bottom of that wick, so we can see the very, very bottom of the wick touching our horizontal line. And then we'll take another line, horizontal line, and place it at the top of the body of our, demand candle. This is our lowest candle. Next, we're going to be taking another rectangle and basically we're just going to draw over where those two lines are. So ignoring this one here, so we don't need that. Here we have our potential demand zone. Based on this supply area here, we've seen the spike in volume, we've seen the rapid movement in and out of this zone. So this price is approximately 1.067, 1.068, all the way just below 1.07. But using this method, we can actually get extremely accurate with our potential entries and exits. So what we can expect from this area is the price to, in the future, hit it, retrace back to it, hit it, and quite likely reject it, often causing a rapid movement of price action away from this zone again. So as we can see, the price has risen up, fallen back, hasn't hit the demand zone yet, it's risen up again, it's fallen back, and what we see here is the wick of this candle has just pierced our demand zone, and now this is where we would be looking to enter. Now, I know it looks quite a difficult entry, but when you get good at drawing your supply and demand zones and confident in using them, eventually you should be able to enter all the way down here, especially when we use multiple time frame analysis. Now, that's something we will be going over in another video because it's quite a long one, but it's an essential technique that you can use in combination with our supply and demand zones to really get your entries super accurate. So what we see here, price has retraced back to our demand zone. We've seen an actual spike in volume, and then it's retraced a fair amount of pips from there, actually, 120 pips. So ideally, you would have entered long in our demand zone. Now, risk management, we could, if you can get the entry, be looking to place our stops just below the demand zone. That covers your downside risk, because if it breaks below this lower side of our demand zone, it basically nullifies it nullifies the demand zone itself. I mean, we see that here. It's broken through, and we do get some good retests towards the downside, but once it's broken through, we can often consider that is no longer valid as a demand zone. So, after a bit more practice and using the multiple time frame analysis, you can eventually learn to reduce your stops all the way down, keep them real tight by using the multiple time frames. But for now, keeping things simple, we'll just be placing our stop below our demand zone like that. Targets, entirely up to you. You can use ratios, 2 to 1, 3 to 1, you can use price action. Price action is actually sort of signalling a good place to exit actually around here. I know we see a full move up to here, but these wicks are fairly strong at the time, and I would have probably preferred to have exited there based on the price action itself. So, in comparison to our demand zone, we have supply zones. Now, these are areas of price where price action spikes into and rapidly falls back from a certain price level. Now, this price level hasn't actually been tested yet, but we can draw it in to show you. We're going to be taking the uppermost wick of this area. Now, this is actually the previous candle, but that's how I like to draw things. You know, price has reached up there, so that's where we want to take it. And I do want to take this horizontal line at the body of this one. And so this, for me, is quite a nice supply area. Now, we haven't actually had that tested yet. As you can see, price has just been falling. But in the future, we could be looking at this level to see some nice pullbacks to it, and hopefully fall back from this level. So we've got our supply zone at 1.08092 to 1.08299 or 83 is a nice round number. So that's actually quite a good sentiment of price, 1.083. So we could expect in the future price to eventually pull back to this level, test it very rapidly, potentially with a nice increase in volume, and fall back away from this area. So we're looking in the future, we'd be looking to enter when we see confirmed price action showing rejection of this area, ideally on multiple time frames, so we can see previous candles before we enter the demand zone showing significant weakness to the bullish side, and then once we're actually in our supply zone, we want to be dropping down time frames to check the lower time frames, so the 15-minute time frame, the 5-minute time frame. We want to be seeing some nice wicks to the top side, and just a general change in bullish momentum, ready for a nice drop away from that level. So, I hope you enjoyed the actual drawing side of things. That covers our methods to draw our supply and demand zones. Again, give it a practice, see what you think. Ensure that you're drawing your supply and demand zones from the upper body of the candle to the lower wick of the candle, and vice versa. It just gets it nice and accurate. Keep it fairly simple, just keep practicing it, and give the multiple time frame analysis a go with supply and demand and see how you get on. We will be covering it in future videos, so if you're struggling, don't worry. Drop us a message. If you like our videos, subscribe. We're just getting started, really. So, yeah, thanks very much, guys. See you later.